Hi everyone. Welcome to Keerthi's FinFo NRI community. I am CS Keerthana. I live in Dubai. I run the consultancy, a firm which is specialized in NRI services. I've done CS from India. I'm also CMA strategic level from UK. I always bring and explain a video every week in this channel on various topics related to NRIs. If you are looking for the topics in taxation, FEMA as well as investment, then please subscribe this channel. In today's video, let's throw some light on the most important topic that everybody must be googling now, budget 2024. So let's analyze budget, how it is going to impact on the portfolio of your investment in 6 different points. This is going to be very important video for you because this will affect real estate, gold, rates, invests, equity, as well as your investment in startup. So stay tuned till the end. In the end, there is one more bonus point. I'm going to summarize and give a view, my take on the budget. So the plus as well as minus and what is my take. This will be in the end. So let's start now. First point, income tax slab changes. So there is slight modification or changes in the income tax slab. Actually for NRIs this will not matter much, but for resident Indians this will. The standard deduction which is going to impact resident Indians has gone up from 50,000 to 75,000. And the nil tax slab, this will be now instead of 2.5 earlier in the new regime, it will be from 3 lakh. That means you will effectively pay zero tax up to 3 lakhs rupees of income in India. So this is actually important even for NRIs. So now after budget 2024, the new tax slab looks like this. Second point, reduction in the custom duty on the gold. See, earlier the custom duty or the import duty which was levied on the gold was 15%. That is while importing the gold. Now that has come down from 15 to 6%. This was indeed a very clever move by the government to encourage the domestic production, consumption. So now that the cost of manufacturing or production goes low, it is going to boost the production and people are encouraged to consume domestically, so within the country. This was evident in the sharp fall in the gold price from Monday, which was around 7,100. Immediately after this announcement, gold price had decreased to 6,793. So the gold price was also corrected by this move of the government. Third point is related to holding period, that is rationalizing the holding period. See, earlier for different capital assets, for the purpose of computing the capital gain, different holding period was existing. So for some assets it was 1 year, so for some assets it was 2 years or 36 months for another class of assets. This had created lot of confusion and it was not at all necessary. Government had always been planning to rationalize and keep the tax structure simple. So with this motive, they have attempted to rationalize the holding period related to various capital assets. Now they have decided no more confusions. We are going to have only 2 periods. One is 12 months, another one is 24 months. And they have brought various capital assets under this 12 months and 24 months period. What does that mean? They have specified certain class of assets. So any holding period beyond 12 months is going to be attracting long-term capital gain tax. And if the holding period is below 12 months, then that is going to attract short-term capital gain tax. So what are those assets? All listed securities. That means all listed mutual fund units or equity shares as well as the debentures. So these are going to have holding period of 12 months. So if you were holding these investments above 12 months, you qualify for long-term. Otherwise, if it is below, this becomes short term. For our unlisted securities, for example, if you have invested in a startup, then the holding period is going to be 24 months. And even for the immovable properties such as land, building, etc., the holding period will be 24 months. So if you have been holding any land and property above 2 years, then you are going to have long-term capital gain tax. Below 2 years, then this is going to have short-term capital gain tax. So there is clarity now, uniformity, parity, no more confusions. There is one more important update here. You would have heard about InvITs and REITs. So if you want to have an indirect exposure in the infrastructure projects as well as real estates, these vehicles are used. So now this will be in line with equity. That means though InvITs and REITs have the structure of business trust, this will be brought at par with the equity. So if you are investing in InvITs and REITs, which holding period is applicable for you? It is 12 months. So if the holding period is above 12 months, again long term. If it is below 12 months, it is going to be short term. In this way, government has done really a good job in removing all kind of confusions and bringing much needed uniformity in holding period. Fourth point is on everyone's favorite asset class, that is real estate. This budget had been little harsh on real estate investors. Actually, after a long period of stagnation, real estate was witnessing a good cycle and people were making 7 to 9% at least decent return in real estate. Now, all of a sudden, government has announced good and bad news together, and I think it is going to impact adversely. Why? Let me explain. On one hand, they said we are going to reduce the capital gain tax from 20 to 12.5%. So now they have brought it in line with the equity taxation. You don't have to be so happy if you're an investor in real estate, because on another hand, they have taken away indexation benefit. Earlier, a number called CII or Cost Inflation Index was going to be published by CBDT. This allowed the inflation adjustment in the purchase price. Let's assume you would have bought a property 20 years ago. The cost of acquisition would have been so much less, right? Even your 1 lakh would have been holding the value of 1 crore of today. If inflation adjusted purchase value is not allowed, what happens? Whatever you are selling now and your cost of acquisition probably 20 or 25 years ago, that is going to be taken. So your profit will be huge, right? And in real estate, you don't have a staggering entry or staggering exit, right? You make entry at once. If you are giving 1 crore and bought a property, finished. That is your cost of acquisition. You can't average the cost like equity. Same while selling. You are selling it for 3 crores, finished. 3 crores is your sale value. You cannot withdraw 10 lakhs today, 50 lakhs tomorrow, or 8 lakhs after some time in order to optimize tax. So it is going to be at the point of acquisition as well as on the point of sale. Now, if the indexation is removed, what will happen is the profit can be huge. Having said that, this has to be analyzed strictly while considering many of the factors such as how much real estate appreciation has happened after you have invested. So if the real estate had increased at least more than 9 to 10% every year, then probably you won't see much impact, as well as the duration of the holding period. So considering all these things only, you will be able to judge whether the new regime is better or old regime is better. So in case if it looks very complex to you, please take a sigh of relief, because we at the consultancy always believe in helping NRIs in navigating the complex tax issues. If you have significant portfolio of real estate investment and if you're planning to sell them and you are looking for tax planning, please click the link which is given in the description. Schedule a consultation with us. We will be more than happy to assist you. Now coming back to the changes in the real estate capital gain and removal of the indexation on the real estate, let's see how this can impact your portfolio of real estate investment with a real example. Let's assume you have bought a property in 2010 for value of 1 crore. Now, if the indexation was allowed, then the inflation adjusted index value of the property, means inflation adjusted acquisition cost of the property was not 1 crore, but it will be 2 crore 17 lakh 36,000. So now the property acquisition cost has been inflated using CII. So your profit will be roughly around 82 lakh 64,000, and if you apply 20% taxation which existed earlier, this would have been given you the tax liability of 16 lakh 53,000. I'm rounding off here. If the new regime is to kick in and you don't have any indexation, then what will happen? It's a straightforward calculation. You are selling it for 3 crores. You have acquired it for 1 crore in 2010. It is 3 minus 1 crore, which is leaving us with a profit of 2 crore rupees. So now apply 12.5%. They say that we have reduced the capital gain from 20 to 12.5%, right? Now 12.5% without indexation, it will make you pay 25 lakhs capital gain tax for the government. Now tell me, how real estate investors are going to suffer? Maybe this was intended to pop the bubble which was forming in the real estate. In many areas in India, real estate was witnessing a crazy level of growth. Probably government might have felt that it is unsustainable and they didn't want that bubble to form, and to pop the bubble, they have used this surgical strike. I hope this made you get a clear picture of how the so-called capital gain tax reduction in real estate and removal of indexation is going to impact real estate investors. Next one is fifth point. That is the tax changes affecting equity investors, or capital gain tax increase in equity investing. You know, much before this budget, there were a lot of discussion about government being worried about reduction in the FD. So now, because of freely available information, there is increased awareness among investors. For resident investors, how much FD would give? If you consider the taxation impact, post-tax return will be 3 to 4%. And for NRIs, they will get 7% on NRE. Now, even for NRIs, I am not considering any currency depreciation. This is 7% which is paid for NRIs in terms of rupee. If you consider rupee depreciation, again you will get very less. People would have understood the opportunity cost, and there was some equity culture forming in India. They started taking risk, embracing risk, and moving their capital from FD to equity market. Probably government did not like it. This is how the capitalism works also, right? So the government probably would have done this to encourage so-called risk-free asset class like FD and discourage people from equity investment. So what they have done? For short-term capital gain, they have increased from 15% to 20%. This is a sharp increase of 33.3%. And for long-term investors, it has gone up from 10% to 12.5%. This is a marginal increase. Why? Because the tax exemption limit for capital gain from equity has also gone up from 1 lakh to 1.25 lakh in this budget. Even the security transaction tax has witnessed 400% change. Now it is at 0.22%. Overall, if you observe the move of the government, earlier they have removed the indexation which was favoring the debt instruments. Now for equity also, they started slightly increasing the tax rate. They have brought the holding period uniformity, but taxation wise, they say that it is still the lowest when you compare to other capital markets. But they might also be aware that this is one of the fastest growing as well as stable markets. So whatever it happens, market is going to digest this harsh fact and eventually move its focus towards earning. That's why they are slowly increasing the capital gain tax even in equity. The last point is definitely a good news. If you are planning to invest in startup or you had already invested in startup, see, for all listed security investors, this budget definitely had been disastrous. It did not bring any kind of positive news for them. But for startup or investors, VCs or angel investors, this had the big positive news. Pranav Mukherjee in 2012, in order to tackle money laundering, had introduced something called angel taxation. So if the investor had invested above the fair market value in any startup, then they would be taxed at 31%. This excess value would be clubbed with their income and they would attract the taxation of 31%, which was very harsh on startup investors. This also became an obstacle for attracting the funding in startup, was hurting the startup culture, because in startup, if you don't hit the projected revenue figures, you are going to sink eventually. But if you are expected to maintain lot of compliance as well as the documentation, go and convince the tax department, look, this is actually a fair market value and the projected targets are being hit by me, this is going to create lot of anguish as well as this is a headache for startup investors. Nobody had actually paid attention to this earlier. Now the most welcoming move of the present government is they have abolished angel taxation now. So if you are planning to invest in startup, you don't have to bother about this crazy level of taxation at 31%. See, why it was very unfair for them. Earlier, for all the listed securities, what was the taxation applicable? 15% in the short term and 10% in the long term, right? But for the startup investors, that was double, 31%. So who would invest in startup? The risk of failure is so much already. The tax department also will come and ask 100 returns, because when you are investing in the startup, you're going to declare it. It is mandatory for you to declare. Now, you will have to break your head and justify that, look, the projected figure is actually the fair market value, right? Now, these kind of headaches are removed, the roadblock is removed, and this is a very good move done by the Modi government, which is going to boost the startup ecosystem. So, if there is somebody who would have had a smile yesterday and taken a sigh of relief, it is only angel investors, because their taxation is simplified. And if you have a short-term capital gain, that means if you have sold your startup investment before 24 months, it is going to be clubbed as if it is your ordinary income, and the applicable rate is your income tax slab rate. And if you have held more than 24 months, it is actually at par with the listed securities. It is without indexation. Doesn't matter for the startup investors. It is going to be taxed at 12.5%. This actually might clear the way for new cycle of funding in startup and huge boost for startup ecosystem. Are you confused now and thinking still it is not clear how my investment in listed securities, bonds, debentures, real estate, as well as probably the startup which you might be planning is going to be taxed? I want to make this simple for you. Clubbing all the changes, if you are thinking how the tax rate as well as the holding period looks like after budget 2024, please look at this chart. This has listed all the securities, listed securities, unlisted securities, and the holding period and how the taxation is going to be applied in each scenario. So please have a look. This will give you a crystal clear view of the changes of budget 2024 affecting listed as well as unlisted securities. Now, I said in the beginning that I will definitely summarize this and tell you what is my take on budget. As an equity investor, I did not like the budget at all. And even it did not have any big positive neither for the agriculture nor for the middle class people or salaried person. But if you think properly and take a holistic view analysis of the budget, it would definitely be a progressive budget. Why? Because government doesn't want any bubble to be formed in any asset class. They did not want any kind of crazy level of bull run in equity or real estate or gold. They wanted the price to correct. They wanted to see a very slow as well as organic, sustainable, stable growth rate across the asset class. So when you are thinking about economy, this move was indeed a better move. And what mattered to the market or the economy? See, these are the three important parameters. One is capex or capital expenditure, and the fiscal deficit as well as the government borrowing. Fiscal deficit actually had come down from 5.1, which was estimated, to 4.9%. This is a huge positive for the market. And what about the capex or capital expenditure? This is in line with the estimate, that is 11.11 lakh crore rupees. And the government borrowing is also exactly as it was estimated, that is 14.13 lakh crore rupees. So nothing has changed. If something has changed, the fiscal deficit has come down. And RBI had clearly given such a massive, huge dividend to the government, which helped them to reduce the borrowing also. So economy wise, earlier many people were thinking that because it is a coalition government, there might be changes and they might not be able to reach the fiscal targets. Now the fear has vanished completely because nothing was compromised, nothing has changed on achieving the macroeconomic target. This is very strong, very resilient and very stable. And why government would have increased the security transaction tax? Maybe to discourage a lot of FNO tradings which was hurting youth. It was clearly, suggested by the economic survey also. And if you carefully observe, the government had not increased the long term capital gain tax just like it has done with the short term. So, it wants to have a culture where you are thinking about the long term investment and it is discouraging you this trading as well as approaching equity for short term gains. And how did market react? It has ended flat and did not correct as many were expecting. It would have digested the harsh truth and it was already expecting that there would be some capital gain related changes which would be introduced by the government. So maybe this was already priced in and it has redirected its focus towards earning and growth. And what matters at the end? It is fiscal prudence and your ability to grow sustainably, which is happening in India. So to end this note, I would say for an economy, what matters is capex or capital expenditure because this will decide the long term sustainable growth in any economy. So, the capex as well as fiscal prudence. You can't be ticking a bomb like US because they have crazy level of debt there and everything looks like bubble and we don't know how long this kind of growth is sustainable there. So, for an economy or at an economy level, what matters is fiscal prudence, capex, and sustainable growth that India seems to be achieving. And at an individual level, what matters? Do you know how to pick right theme, right asset class, and allow the earning to compound significantly, optimize the taxation at the time of exiting or selling off? If you can do all of these things, plan strategically, then nothing to worry at all. These are all temporary changes. Eventually, for market, this will be nothing and they will be redirecting the focus towards the earning and growth and it will grow from this position. So that's all for today. If you have any doubts on the points that I've raised in this video, please do let me know in the comment section. I will be more than happy to clarify and clear all your doubts. See you with another interesting video next time. Till then, bye bye.